Thanks so much for joining us for today's presentation on the Investment Optimizer, hosted by your friends at Money Insights. My name's Christian Allen. I'm the president of Money Insights, and I'm with my partner and co-host of the Money Insights podcast, Rodney the Pod Zabriskie. Rod, I'm excited to jump into this today. How are you doing?
I am doing great. Yeah, it's going to be a good one.
The reason we're excited about this is because it's one of the core philosophies that we teach at Money Insights, and the focus is really simple. The Investment Optimizer literally is there to add an additional layer of profitability to the investing that you're already doing. We're not going to change the underlying investments. We're just going to talk about where and how to flow money in order to create additional return, additional dollars and cents. We're going to show this in the math and exactly how the Investment Optimizer does create that additional layer of profitability. So here's the question, Rod. What is the problem? The problem is that people are using inefficient opportunity funds. In other words, there's not that many places that I can go to keep my money doing all the things I'd like it to while it's in between investment deals. In general, what we see is people will, especially cash flow investors, but really it could be anybody, are building up money inside of like a checking, savings, maybe it's even in a traditional stock market based account, but they're building up money in these accounts that don't have the benefits or the necessary items that you need from an ideal opportunity fund. So what does the Investment Optimizer do is it solves this problem, and it does it by creating these 5 kind of key benefits. First, it's liquid. We need to know that it's liquid and it's there at the time that we're ready to invest it. That's important. We want it to be safe, right? There's obviously inherent challenges with things like maybe the stock market as an opportunity fund or cryptocurrency as an opportunity fund. And the reason is because we want to make sure that when the investment deal is there and ripe, that we have the cash, that it's there for us, right? It's safe, it's there. We obviously want money to grow. We don't want our money on the sideline doing nothing for us. Especially the more prolific we become as investors, the bigger those numbers end up getting, and therefore it ends up becoming more and more inefficient. So we want to make sure that we're creating growth inside that. And then we want tax benefits. We talk about savings and money market. Like I said, they're liquid and safe, but that's about it. We're not getting any, whatever growth we do get from there, we're also going to get a 1099 that follows. So one of the benefits that we're going to talk about is how the Investment Optimizer has several tax benefits, but the key one being able to create tax-free growth. And finally, this is what people get most excited about. It's the ability to use leverage and create value in multiple places at the same time. So with that being kind of our context, let's go into the actual numbers. Rod's done a great job of putting together numbers that really play out and show how the Investment Optimizer compares to some of the other things that people often use as their opportunity fund.
Perfect. And so we're just going to do a head-to-head, right? We're going to say if I'm using the Investment Optimizer as opposed to the savings account, which is kind of what we're proposing here, then how does it come out? So our basic assumptions to begin with are we're going to assume that this person is setting aside $100,000 a year for 5 years to capitalize their opportunity fund, okay? And they're going to start investing with those funds. So initially we're going to invest in a syndication, a real estate syndication. And then after that, as we continue to put money into the opportunity fund, and as that syndication is kicking off some cash flow, we're going to capture all of that inside of this opportunity fund and then go out and start buying additional real estate properties. When we go buy those properties, we're going to put 20% down and we're going to get an 80% loan through a traditional lender. Okay. Again, leverage, right? And then as we invest, we're assuming a 15% cash flow from those properties, and we're going to assume a 5% appreciation. Now, before I move on, let me just really quickly hit on this. Sometimes when I bring this up, people will say, well, I wouldn't do a deal if I only got 15%. And other people might say, I only wish I could get 15% consistently out of my deals, right? The point isn't as much about the specific numbers. This doesn't necessarily represent any individual's investment experience as much as it is to say, if we apply the numbers equally on both sides of our comparison here, then we can see on an apples to apples basis how we come out. So let's look at those numbers. All right, a lot of things to look at here. The thing I want to point out first is the difference. So when we look at a 20-year time frame of this initial $500,000 going in and the flow of investing like we talked about, we end up with a little over a $2 million difference by using the investment optimizer as compared to using a traditional savings account. Now, let's kind of break it down a little bit, because initially you may have noticed in the first year, that first syndication we go and invest in, on the right-hand side, we have our full $100,000 ready to go in. On the left-hand side, $74,000 going. Okay, we'll get into the vehicle and what we're using here, but we own right up front there are costs to doing that. But what happens is, if you look at this year 10, when we go and make this purchase, by this point now we have more of a larger property that we can purchase because of the things Christian talked about, the growth and this additional efficiency by having value in multiple places at the same time. And that difference just gets bigger as time goes on. So that by the time we get to the end of those 20 years, we end up with $2 million of more value. Now, sometimes we show this and people are like, well, that just seems too good to be true, right? Well, one of the things I want to just real quickly point out is that the real estate investing creates an enormous amount of value. Right? And we're not saying that the investment optimizer creates that value, but what it is it's enhancing it. It's augmenting that so that the same person's using the same 500,000 instead of ending up with $20 million at the end of the 20 years, ends up with $22 million at the end of the 20 years. A big difference.
Yeah, and 10% is 10%, right?
Yep.
We're going to talk about how to take that up a notch, but if you asked me, would I prefer to get the additional 10% or not, doing virtually the exact same thing, it ends up kind of being a no-brainer.
Absolutely.
So let's talk a little bit about the vehicle. We're using what we call max overfunded dividend-paying whole life insurance. And every time we say it, it feels a little bit longer than the time before. But those are important words. What they ultimately mean is that we are minimizing cost and maximizing cash. When we talk about permanent life insurance, there's two components. There's a cash component and there's a traditional insurance component. Well, the goal, the focus, our commitment to policyholders is that we will get as much into that cash as we possibly can while still keeping the tax benefits intact. So that's super important, and that's the reason that we get that mouthful of a name for the underlying vehicle. Here are the 6 key benefits that we get from it. 1, it'll create about a net 5% return. This varies slightly based on age and health, but for the most part, we're getting people in that 5% return range. The second thing is that we talked about tax benefits before, but because it's life insurance, we have the ability to utilize money tax-free in the form of a loan. And that's the key there. Because we're bringing it out on a loan basis, and we'll talk a little bit more about what a loan means in this situation, we want it to be safe and predictable. We like to work with companies that have been around and have done this for a long time and have an incredible track record. So we only work with A-rated companies, and most of the companies we work with have been around for a couple hundred years or close to it and have had an incredible track record of paying dividends for the entire time frame they've been in existence. So we feel really good about the safety and predictability that we get from it. It also has to be liquid. Like we hit on before, when the investment deal comes up, we have to have the liquidity to be able to take advantage of it right there and then. There's a death benefit. And the reason we highlight this is because while we're focusing primarily on the living benefits of life insurance, it is significant. And because of the way that we structure them, there's going to be a death benefit that regardless of how we use the policy, that death benefit will come into play. It's there to take care of people that might be relying on us financially if something were to happen to us. Finally, Rod, it has the benefit of using the loan provision. And we're going to talk a little bit about why the loan provision ends up being so important. But basically, it creates the tax benefit and it allows us to arbitrage, which we're going to get into here in a minute. Okay, so now that we've hit on all of the core benefits, Rod, why don't you dive into the strategy for us?
Absolutely. Okay, so we're taking our money, we're putting it into this max overfunded life insurance policy that Christian just mentioned, and he talked about the growth that's predictable and consistent. Well, the two things that create that growth are, number one, we have a guaranteed interest rate. The specific rate may differ from company to company. It's going to be anywhere between 2% as a minimum up to 3.75% tops. Most of the companies are ending up right around 3%. But the point is that we know we can count on that much growth year in and year out on a guaranteed basis. We know we're going to get that. But in addition to that, we also get a dividend. What's happening is we're using specific life insurance companies where the policyholders themselves become owners of the company. And therefore, when the company pays out a dividend, the policyholders capture a portion of that. These companies are very consistent at paying out a dividend so that it's not guaranteed. and yet they've just been very, very consistent. And that's ultimately what creates that net 5% return that Christian referenced just a minute ago. Okay, so that's what's happening inside of the cash value of the account. What we do then is we take that account, it becomes our opportunity fund, and like we said earlier, we're going to use this money. But when it comes time to go out and invest, I'm not going to take the money actually out of this bucket. Because I have the money in this bucket, I have access to a much larger bucket, which represents the general account of the insurance company. When I'm ready to go out and use that money, go out and invest, what I'm going to do is actually take a loan from the general account of the insurance company, using my bucket as the collateral for that loan. I take that money and go out and invest it and create some sort of cash flow. I'm going to take that cash flow and funnel that back into, technically speaking, what I'm doing is paying down my loan, but strategically, what I'm going to be doing is replenishing the opportunity fund so I can go back out and do it again. So think about the side-by-side comparison we showed just a minute ago. That's exactly what we were doing. Invest, create cash flow, capture that cash flow, reinvigorate the opportunity fund, and then go back out and do it again. While all of that is happening, on the left-hand side, my bucket just stays there and continues to grow because there's this kind of separation between the two. I'm flowing all the money through the right-hand side, and because of that, my money just stays there. It's acting as collateral against that loan, but it just stays there. And so that's how we create value in multiple places simultaneously. Okay, so let's talk a little more about leverage. Okay, obviously this is what we're doing here, right? We're leveraging what we've built up in our opportunity fund to go out and do our investing. It's creating this tax-free growth. And like we just showed, we're creating value in multiple places at the same time. Let's also talk about this idea of an arbitrage. That money that's growing is growing on a compound basis. At the same time, as I'm flowing that money through my investments and back and paying down the loan, I end up paying simple interest on that loan. I think a lot of people understand that there's a difference between compound and simple, but what I want to do is just really kind of nail down an example so we can kind of quantify what this difference looks like. And first, visually, we're going to do this because on the left-hand side, we have the compound curve. On the right-hand side, as you can see, it's simple interest, but not simple even just on on a level balance, but on a decreasing balance. And so that makes a big difference as well. And to illustrate this, what I want to show is what it looks like if I take a $100,000 loan and amortize the payback of that loan over 20 years. Now, to be clear, there are a lot of different ways we can build the payback of the loans. It's up to us to decide how we're going to do that. For this example, I'm just going to make it an even payback over 20 years. So I take the $100,000 loan. My payment is about $8,000 per year. When I fast forward to the end of the 20 years, and I've paid off that loan, I will have paid a total of a little over $60,000 in interest. But simultaneously, I have $100,000 collateralizing the loan, but it's sitting in my cash value, growing and compounding. And if I assume the same 5% rate of growth, $100,000 compounding over the 20 years, fast forward, I will have earned a little over $165,000 in interest in my account. So put them side by side. I earned $165,000, I paid $60,000. And so just in this very simple example, I earned $105,000 more based on that compound growth versus what I paid in the interest. And so that creates a really powerful arbitrage as I'm just doing my investing.
You know, what's really incredible about this, Rod, is that it's on a 5% growth rate and paying 5% on the other side. So it's literally the same interest on both sides.
Yep.
And again, the reason that we illustrate this is because there's a difference between those two. Again, if we're arbitraging compound interest and simple interest, even if the interest rates are exactly the same, we can create this significant benefit. And it's just a matter of understanding the math behind it. So let's talk about how to kind of take things to another level, Rod. The example that you showed, again, was paying 5 and earning 5. And just doing that alone created that $100,000 additional benefit. But what if we were to take that up a notch and utilize what we call a cash value line of credit? And the reasons that we might do that are really, really simple. If the interest rate on my policy is 5% and I can go out and get a 3% loan from a bank, then instead of arbitraging 5 and 5, I'm now arbitraging 5 and 3. So Rod's going to talk to us here in a second about kind of what that looks like and why that additional benefit is there. But just from a reference standpoint, we have a list of banks that do this. You are more than welcome to check with your local banks. A lot of local banks will do it as well. But if not, feel free to reach out to us and we're happy to get you a list of the banks. One of the other benefits I want to hit on before we get into the example is just the idea of being able to switch out the loan when interest rates go up. Now, instead of carrying it on the cash value line of credit, we can just take it back in, carry it inside the policy. So with that said, Rodney, why don't you show us what it looks like when we add that layer, the cash value line of credit, and are paying a lower interest rate on the loan?
Perfect. And so what I'm going to do is build on things that we already looked at. So a minute ago, we compared the compound and simple 5 against 5. On the compounding side, we earned $165,000. Well, that's the same, okay, because the earning side is still at the 5. But when we switch out and do the 3, as a reminder, when it was 5, we were paying about $60,000. At 3, we would end up paying about $34,000 over that 20-year time frame. And so, again, what was a $105,000 difference becomes about a $130,000 difference. When we then take that and extrapolate that, like we showed on that side-by-side comparison, over multiple deals, continuing to flow that money in and out based on that original $500,000 that we showed going in. Again, as a reminder, the difference was a little over $2 million by using the investment optimizer as opposed to the savings account in the previous example. And we kept everything else the same. Same dollars going in, same investment pattern, same 20% down and 80% financed when we go purchase those properties. But the difference here is by having a 3% interest rate on the loan side that we're paying, now we actually get a $3.1 million difference. So in other words, we increased that difference, that value by 50% just by substituting in the cash value line of credit.
Crazy, Rod. Every time I look at it, it just feels like more and more of a no-brainer to use. Why don't we conclude by talking about the key takeaways? First and foremost, the focus is adding a layer of profitability for investors. And that's really the emphasis, that if you get nothing else out of the presentation, know that by utilizing the investment optimizer, despite all the other kind of benefits that exist inside it, the key and most important one is that we literally add profitability, dollars and cents to investing that we're already doing. But the benefits are that we can do it tax-free because we're utilizing life insurance. Similarly, it's safe and predictable. We're working with companies that have been around for 180 years and have never missed a dividend payment. One of the other benefits we haven't hit on in a lot of detail is just the value of creditor protection. This varies a little bit from state to state, and yet inside of our strategy, it's really easy to make sure that it's completely creditor protected, regardless of where you live. And of course, that's important because the greater our net worth becomes, especially if I'm a high income earner and I'm continuing to build wealth, there's more and more exposure that I have. And so making sure that we have assets that are creditor protected becomes extremely important. Finally, I want to hit on something we haven't hit on much throughout the presentation, and that is what we call phase 2, or the tax-free retirement income phase. And basically what we want to hit on here is just that during our investing days, like as long as we want to be, we can be investing and utilizing the policy to increase and add profitability. There may be a time when we decide to slow down and decide that we're not going to continue to go at the same pace, and we may want to turn the cash in our policy into an income stream. One of the values here is that in what we call phase 2, it's really easy and extremely effective to turn the policy's cash value into a consistent and high-paying tax-free income stream. Thank you, everybody, for joining us for today's presentation on the Investment Optimizer. Feel free to catch us at moneyinsights.net, and we'll talk to you soon.